A third of all US bank deposits, $6 trillion, could leave for stablecoins. That is what Bank of America's CEOs warned investors earlier this year. And the reason is simple. Crypto exchanges figured out how to legally pay 4% interest on digital dollars, while traditional banks are paying you close to nothing. The Federal Reserve and banks assumed stablecoins could never compete because the Genius Act, passed last July, banned stablecoin issuers from paying interest. But some platforms like Coinbase were already running rewards programs, and they argued the new law only banned issuers like Circle and not exchanges. Now, whether you call it a loophole or clever compliance, it became a big enough problem that the White House intervened, setting a March 1st deadline to get banks and crypto firms to compromise. Now, that deadline has passed with no deal, and right now the standoff continues. So, how did we get here? In July 2025, Trump signed the Genius Act, the first real federal framework for stablecoins. It required issuers like Circle to back every coin one-to-one with reserves, get monthly audits, and give holders bankruptcy priority if something goes wrong. Pretty standard stuff. But banks mainly cared about Section 4A11, which explicitly banned stablecoin issuers from paying yield to holders. No interest, no tokens, nothing. Banks looked at that and thought the competitive threat was contained. But the law only banned issuers from paying yield. It didn't say anything about exchanges or platforms. And so by late 2025, Coinbase was offering 4% and Kraken 5% rewards on USDC compared to Chase at 0.01%. Banking associations started flooding Congress with letters demanding they close what they now called a loophole. But the crypto industry argues that it was intentional. In December, the Blockchain Association, representing 125 companies, including Coinbase, Kraken, and A16Z, sent a letter to the Senate claiming Congress intentionally preserved the ability of platforms to offer rewards. They argue it was a negotiated compromise, not a mistake. Even the Fed didn't catch it. In November, months after Genius passed, Fed Governor Stephen Moran gave a speech explaining why stablecoins wouldn't pull deposits from banks.
Because Genius Act payment stablecoins do not offer yield and are not backed by federal deposit insurance, I see little prospect of funds broadly seeing the domestic banking system.
So why would Americans move their money? Now, that argument made sense on paper, but in reality, the yield programs were already live. Earlier this year, the American Bankers Association made closing this loophole their top priority. More than 3,200 bankers even signed a letter to the Senate asking for the yield ban to apply to all exchanges and affiliates. The reason is simple. Deposits are banks' cheapest source of funding. If deposits start moving into stablecoins instead, banks either have to cut back on lending or find more expensive ways to fund it. Now, the Fed actually modeled this in a study. In the moderate scenario, where stablecoins grow by $600 billion, lending shrinks by $190 to $408 billion. In a high adoption scenario, the reduction could reach 1.26 trillion. So, in other words, that's hundreds of billions of dollars in loans that never get made. So, Congress responded with the Clarity Act,
the Digital Asset Market Clarity Act of 2025,
which would extend the yield ban to any digital asset service provider. And it specifically targets passive yield, the kind you earn just from holding a balance. Activity-based rewards tied to payments or staking would still be allowed, so there is potential for exchanges to restructure and stay compliant, But in mid-January, Coinbase withdrew support for the bill entirely, saying it would effectively kill stablecoin rewards. Now, the Senate was supposed to vote the next day, but postponed. A few weeks later, the White House stepped in. Patrick Witt, the executive director of the President's Council of Advisors on Digital Assets, started brokering talks between banks and crypto firms, with March 1st being the deadline. The idea is to stop massive deposit flight from banks while still allowing rewards for people actually using the network, but getting both sides to agree on the exact language has been difficult. And then on February 25th, the Office of the Comptroller of the Currency released their proposal. Now, the OCC is the federal agency that supervises banks and writes the actual rules for how the Genius Act gets enforced. Their 376-page document restricts third-party yield arrangements and essentially says what Coinbase is doing probably violates the law. But that raised questions. Are the White House negotiations even necessary anymore if the regulator already decided? March 1st came and went, no deal. According to reports, negotiations are still happening. Both sides are revising draft language, but there is no agreement yet. So while Congress figures this out, it's actually worth thinking through what the financial system would look like under different scenarios. So let's start with where we are right now. So right now, stablecoins hold about $310 billion. That is less than 2% of total US deposits. The exodus hasn't happened, even with stablecoins paying up to 40 times what traditional banks offer. And honestly, it's probably down to three things. First, most Americans, honestly, they don't know how to buy USDC, and they don't think of Coinbase as a place to store money. And a lot of people just don't trust putting savings into anything that is labeled crypto.
None of that crypto stuff.
And so that psychological barrier is doing more to protect bank deposits right now than any regulation. But if stablecoin yields become permanent, that barrier will erode over time. The Fed said that smaller banks could see their deposit bases collapse, while giants like JP Morgan and Goldman are actually already launching their own digital asset infrastructure to survive the shift. Now, if Congress closes the loophole, there is global competition that deserves attention. China is piloting interest payments on its digital yuan. Users outside China can't access it, but they're modeling what yield-bearing sovereign digital currency looks like. If the US bans stablecoin yields while rival nations build theirs around them, that capital might flow offshore. And then there's the political math. Even if banks win the policy argument, they still have to win the vote. The crypto industry spent $131 million in the 2024 election cycle, helped elect 274 pro-crypto candidates to the House. Fairshake, their main PAC, has $193 million ready for the 2026 midterms, and that is serious leverage when you're trying to pass a bill that the industry opposes. And finally, the US government itself is not in agreement. While banks want to restrict stablecoins, Treasury actually wants them to grow. They buy US government debt. Tether holds over $130 billion in treasuries, more than countries like Germany. Secretary Bessent expects stablecoins to create $2 trillion in demand for bonds. So Treasury needs stablecoins to help finance the national deficit, while regulators are trying to kill what makes stablecoins attractive. So even if everyone agreed that the loophole should close, right now it's not clear that the government is aligned enough to actually do it. So where does this leave us? Banks have had a century without real competition for the simple service of holding your money. The fact that a 4% yield on a stablecoin has them mobilizing thousands of lobbyists and flooding Congress with letters tells you just how influential stablecoins have become. So, will banks and crypto find a way to coexist, or is this the beginning of a great deposit migration? Well, make sure to give us your thoughts in the comments below. Bye.